In section 5-1, we are going to be talking about using checking accounts. So there's a lot of things that come along with having a checking account, and we're going to walk through those steps for a business. So for starters, it's important to understand that when we're talking about using cash to purchase something, we're typically talking about writing a check, and there's some real reasons that companies do not use cash. It is okay for companies to use cash, definitely for small cash payments. If you're going to purchase stamps at the post office, it might be a lot quicker to just pay cash. You might have just a little bit of cash on hand in order to do something like that. But there's a lot of issues related to using cash. So the first one being the chance of recording errors. Maybe you paid $10 for the check or $10 for the stamps, but you didn't get a receipt, and when you got back, we need to record that purchase, and you don't have a receipt telling you how much it was for. So maybe you put $15 accidentally. So recording errors is an issue. The next two are fancy ways of saying something, but ease of transfer without any question about ownership. That's a fancy way of saying stealing. It's a real issue. And then just losing cash. So if you lose cash, it's pretty much gone. Nothing you could do about it. And then the final bullet point there, safety measures. If you have cash on hand at your business, there needs to be additional safety measures. You probably need to have a safe. You probably need to have maybe a security system. So companies can use cash, but there's a lot of issues with doing so. So it's important to understand that a check, we think of it just as a piece of paper, maybe with some birthday money, but really what that piece of paper is a form telling a bank to pay cash from one bank account to another, from one bank account to be cashed, one bank account to another to be deposited. So in order to write a check, you first have to have a checking account. So you can't have a savings account and write a check from that. So you need to have a special account called a checking account. And when you open a checking account for the first time, you're going to need to have two things. First one being a signature card. So you're going to put your signature most likely on a digitalized pad, and they'll save your signature to have on hand. And then you're also going to get deposit slips that go along with your checking account. So a deposit slip is something that maybe you fill out before you make a deposit at your bank, or maybe the bank will fill out when you get there. But a deposit slip looks like this. So you would break down the information such as the date. If you had cash, you would put any cash deposited here. If you had coins you were depositing, they'd go here. Most often with businesses, you might have a list of all the checks that you're going to deposit, and those would be listed there. So deposits make the cash balance increase at your bank account. So if you deposit, it's going to increase the cash balance at your bank. So when we make a deposit, we need to fill that deposit out on something called a check stub. So a check stub is what is left after you tear a check out to pay someone. The check stub is what you're left with. So you might want to draw arrows on your note guide showing where these numbers are coming from. But we take the balance to start, which we started with a zero balance. So that's pretty easy, probably our first transaction as a business. Maybe the owner invested $2,000 in the company. Date of the deposit, and then the amount for the deposit, $2,000. So we went from zero in our bank account, and then we deposited $2,000, and now our new total is $2,000. So that is how much we have at the bank, in our bank account, in our checking account. So you've maybe gotten a check before, and when you took it to the bank, you signed your name. That is called an endorsement. Until there's a signature, that check remains the ownership of the person who wrote the check. But as soon as it's signed by the person the check is for, that transfers the ownership to that person. So the signature is called an endorsement. We have three different types of endorsements that transfer the ownership of the check. The first endorsement is probably the most common, maybe something you've done yourself, a blank endorsement. So you sign your name. If your name is on the front of the check, You sign your name on the back, and then that is as good as cash to you. That is why it should be really important that you wait to do this until you're at the bank. When you get to the bank, then you sign your checks. Because if you would sign that check and it matches, the name on the front matches the signature on the back, that check is as good as cash to anyone who finds it. So wait until the very last second to sign it, until you're in line at the bank, and you can hand it over and get the cash. So a blank endorsement is the most common, something most of us have all done. Next is a special endorsement. This is a pretty interesting one, not as common, but let's say you have a check written. So our check was written to, in this situation, Michael Delgado. So the check was written to him, but let's say he owed this Helen Goldsmith money. Instead of Michael Delgado going to the bank, cashing the check, and mailing the cash to Helen, he transferred ownership of the check by saying pay to the order of Helen Goldsmith and then signing his name. That transferred the ownership from him to Helen. A restrictive endorsement restricts what can happen with that check. So oftentimes a restrictive endorsement is a stamp. So on this slide, the pink is a stamp. So as soon as checks come in to Delgado Web Services, either the secretary or the accountant or whoever receives the checks, first thing they do is put the stamp on the back. So that way, if anyone would find it, even if they did sign Michael Delgado, the owner's name, it could still only be deposited into that account. So it's not really good to anybody as soon as this stamp is on there. It's restricted for deposit only to that account. So that is a very common endorsement. A lot of companies, maybe if you even see someone pay with a check at a cash register, oftentimes there will be these stamps right in the cash register to stamp that check right away. So what I would do is I would label on your note guide these different steps of completing a check stub. So completing a check stub, which is the left side of this check here, this is always going to stay. You're going to tear off and hand this check over to Eastside Supplies. So the first thing that we do is complete the check stub. So we start by working top down. The amount for the check, $165. The date is January 2nd. This is to Eastside Supplies. The purpose is to buy supplies. And then the last thing you do, we have already calculated that $2,000 total. That's how much we have in our account after we made that $2,000 deposit. Now we're going to write amount for this check. The amount for the check is $165. So then our new balance, the amount that should be at our bank account after Eastside Supplies cashes this check, is $1,835. So that is a completed check stub. You want to do that first, because as soon as you write a check and hand it over, then you don't have anything to fill out the check stub. So we always fill out the check stub first, and then we'll complete our check. So all the information for the check comes from the check stub. So we have our date. You might want to draw an arrow from the check stub to the check on your note guide if you would like. Number 7 is the date. Number 8, who we're writing the check to. 9, the dollar amount written in numerically. 10 is the dollar amount written using words. The purpose of the check, and then finally the signature. You'll notice on your note-taking guide that steps 9 and 10, so where we write the number numerically and where we write the number using words, those need to match, because you're saying how much this check is for. But let's say they did not match. The bank could refuse to pay it. They could refuse to cash the check if those numbers don't match. But if it's just a small difference, step 10, where you write in words, that is what is the ultimate factor. So that would be the one that they would choose if those two numbers don't match. So that is really important, that those two numbers match when you're writing the check. A post-dated check, this is a situation where a check for October 27th is written and it's only October 20th. So the date hasn't even occurred yet. This is not something that a bank will cash. So a post-dated check for a date that's in the future will not be cashed by a bank. A voided check is a check that cannot be processed by the bank because for some reason it is invalid. We'll talk about different reasons that it could be invalid. But if there's a voided check, we still want to show what happened to that check. So in this situation, check number 24 was voided. We don't want to have our journal say check 1, 2, 3, check 22, check 23, then jump to check 25, because we'll wonder what happened to check 24. So we still need to record a voided check, even though nothing was ever done with it. It was never cashed. So we go through the dates as normal. We write void. There's no account that this is going to because nothing ever happened with that check. It is check 24. There's nothing to post, so we have a check mark. And then we even put a line through the cash credit. Typically, when you write a check, you would have a cash credit amount, but nothing was done with that check. It was voided, so we even put a line through the cash credit amount. So we always, even if checks are unused checks should be retained for records and be recorded in the general journal. So that's what we just did. And we write void in the account title. And then we remember to always fill out the check stub before the check. That's a really important thing with checks. Check yourself here. What are the 3 different types of endorsements? Fill those out. See what you can remember. Pause this video. And then be sure to check your answers before you move on to section 5-2.